Hello, how are you? Can you hear me? Can you see the screen? Apologies for a quick delay. Okay, let me check really quickly. All right, so nobody sees me. That's not good. Let's see. All right. So today, while we're still figuring out the webinar options, I'm going to. My name is Peter Borvik. I'm one of the senior partners at Brooklyn Risk Advisors, and today we are going to go over what is Wall Street, why Wall Street is important, and specifically why trading is one of the most imminent industries that exist over there in life to support the economic development of the countries, of the world, etc. Because many people believe that trading is just a money-making machine, and it's possibly true. But besides that, trading does serve the world as one of the best mechanisms for providing liquidity and actually developing business relationships. So let's see if anybody can see me now. All right. So still not sure if now for those of you who actually hear me, there has to be a question mark somewhere, and that question mark um, allows you to ask any questions you have, and maybe help me set it up while my guys are trying to fix it. Okay, no questions, no nothing. That's always great. Okay, still trying to see if you guys can actually hear me. Let me try to. Again, apologies for this delay. It's one of the first times we actually doing that thing. Let's do something easier here. All right. So again, while we're working on setting this up, setting up the webinar, you should be thinking, in my opinion, you should be thinking about trading not as just a money-making industry, which it definitely is, but more of the industry that can actually really add value to the world, to the economic development of a country, whether it's in the US. So because that kind of thinking will actually put you so much ahead of your competition compared to people who just want to make money out of the industry. Right? So let me see if this is working. It seems like it is working, and we have to proceed to the presentation as soon as possible. All right. Seems like it's all working. So it seems like it's been actually working for the last 10 minutes. Let's see. No questions. Okay. All right. So this is what we're gonna do. Let me give you a brief presentation about what is Wall Street and why Wall Street is so important. A little bit about history and also the reasons why trading is important, right? So if you look at those five people, it's Warren Buffett, Bruce Kovner, Ray Dalio, James Simons, and Tudor Jones. Their net worth is $84 billion, right? Which is greater than the GDPs of so many countries that exist out there in the world. So the question is, what the hell is Wall Street, right? What is Wall Street? So historically, it's been that Wall Street is just street outside where uh, guys who would like to buy or sell the stock, they would come to Wall Street. That's where that's where the activity was presented, and they were literally yelling their orders to the guys. To the brokers who were leaning out of windows, right? So that's exactly what was happening. And since it probably was sometimes cold and sometimes it was raining, these guys decided to, build actual building around Wall Street and call it a stock exchange. And that's why the New York Stock Exchange, the NYSE, and the Nasdaq, and the Amex, all these guys were built around that area because that used to be just the most popular area for this kind of activity, right? So that's how it looked like back in the beginning of the 20th century. And right now, for those of you who don't know, obviously that's a little bit of an old picture. Wall Street is located somewhere here with the bull, right? And the twins do not exist anymore, unfortunately. But it exists somewhere here by the letter 2. So Wall Street is physically located in New York, in the downtown. However, at the same time, lots of activities right now is really placed somewhere here, close to the park, close to the 57th Street. That's where all the hedge funds and the research firms are located right now, after the 9/11. Many firms actually moved from downtown to uptown, so it's still called Wall Street, but it's not located on Wall Street anymore. I think of the big banks, it's only Deutsche Bank, which is located right down there. Uh, Maybe I'm missing something, but basically got the idea. Now, that's how it looks like. And yes, NYSE is a floor, but now NYSE is just for the tourists. I've been there a couple of times, and yes, it's all pretty much empty. It's all been people have been replaced by complicated algorithms, and it's not as busy as it used to be. Nobody's bidding each other anymore. Nobody's really yelling. It's just a cool, old group of people who just try to make big buck and try to still provide some liquidity on the trading floor. But it's now, for the most part, it's for tourists. So if you look at all the institutions, financial institutions that are out there that can help you manage your money. We have investment banks, we have mutual funds, pension funds, hedge funds. We also have insurance companies, which I did not include here for some reason. But those are the major investment vehicles that are out there to help manage your money. So pension funds, the biggest problem with pension funds is whatever the money you do, yeah, sure, whatever the money you give them, sure, it's tax free. So from what many traders told me, and that was quite surprising to me, the majority of traders actually said that the best investment is a pension fund because they were able to save 35% tax. And I personally think that's not a good mindset to have, because trading should not be about saving money. Trading should be about making money. It should not about cutting down your cost line. It should be more about improving on the sales. So the problem with the pension funds is obviously you have to hold your investments there until you're 65 and a half years old, if I'm not mistaken, or 57 and a half, I forgot. But basically, it has an opportunity to give you some returns, but you're locked in for a long period of time. Mutual funds. The beauty of mutual funds is literally anybody can invest in a mutual fund. And mutual funds are only involved in longs and shorts. Longs. They cannot do any short positions. So you can only buy the stock. You cannot short the stock. So if you think the stock is going down, there's nothing you can do unless you own the stock and just get out of the position. Now, mutual funds, on average, only generate 4% a year. Now, you also have to keep in mind that that it's 1 to 1.5% commission fee that you have to pay to the fund, mutual fund manager, and there's also tax. So you really just making about 2%, and 2% is just helping you save against the inflation, but nothing more. Investment banks, including JP Morgan, Citigroup, HSBC, right, and a bunch of other banks, Nexus, SocGen, all these guys. They exist there for the big boys, for the bigger boys, and they do have certain wealth management, sections for individual investors who has net worth of $1 million and above, so-called credit investors. But for the most part, they provide advice for the companies. And lastly, but not leastly, hedge funds, right, such as SAC, Bridgewater, for research management. Those guys are the investment vehicles that can both short and long, and they can also do all kind of crazy stuff when it comes down to investments. And they claim to have um, alpha generated for investors, which is not possible through pension funds, investment banks, or mutual funds. And despite the fact that hedge funds do in fact provide those investors, those rich investors, again, credit investors with a net worth of $1 million and above, accredited investors. Although they do provide great service, for the most part, after the analysis was completed, investors do lose money compared to just being invested in the S&P 500. What happens is this: there have been a bunch of research done, for example, at least by the JP Morgan asset management team, where the S&P 500 investment grossed out to about 10% a year, while the hedge fund investment turned out to gross out just to 3% a year. The question is, how come is it even possible? Because the hedge funds do tend to produce high returns. The reason why it happens is because whenever the hedge fund is losing money, everybody's panicking and getting out, and that's the best time to actually hold your position. While when when the hedge funds are making a lot of money, a bunch of hedge fund investors actually get into the hedge funds, but now that's the time to actually get out. So this so-called mean reversion is behaviorally messing up the returns of individual investors. All right, so this is the overview of what's really going on when it comes down to the institutions. Now let's go for the assets, right? So you got stocks, right? New York Stock Exchange, NYSE. You got bonds, you got commodities, you got forex, and you got real estate, believe it or not. But the REITs are the real estate investment trusts. They do get popularity, especially in New York, which is one of the top markets for REITs. If I'm not mistaken, we recently did the research and we found that it's about 200 to 300 REITs, and they are just skyrocketing in value, skyrocketing in the number of those REITs. So real estate is, in fact, can be traded through stocks right now. REITs, you just buy it as if you would just buy a usual stock. The investments for REITs are anywhere from 150 to whatever, $500,000. Sorry, $500 million. And that also produces a great investment vehicles as an asset class. But if you look closely, you'll have about 1,000 stocks which are super liquid. So if you have like anywhere from 100 million to $1 billion, and you go for the stock, you're probably not going to move only 1,000 stocks. The other stocks you actually move, because if there's a huge buyer who came in, a huge seller who came in, and he's and the net worth, the overall money traded volume is about whatever, 100 mil, 200 mil, then they're going to move the actual stocks when buying them or shorting them and selling them, right? Now for the forex, you got only about 10 forex pairs that trade a lot. For commodities, you only got about 20 commodity futures, and obviously 7 maturities for bonds. A year, 2 year, 3 year, 5 year, 7 year, 10 year, and the long-term bonds. So that's what you have. This is the overview of what's really going on. For the most part, I did not include credit here because credit is, well, could technically be under bonds, right? Because we have corporate bonds and we have treasury bonds. But that's really the overview of the asset classes that we have. Again, it's stocks, bonds, commodities, forex, real estate, right? Now, really quickly, what is going on when it comes down to buying and selling, right? So let's say that we have a stock here at $100, and we think that the stock is going to go up. So what we do, we buy it and we sell it at 120 later on. So the profit that we get is $120 minus $100. That's $20 per stock per one share, and we divide that by the initial investment of $100, so we get a profit of 20%. So that's what happens when we open up a long position of the stock. And for the short position of the stock, if you think that the stock is going to go down, say from $60 down to $40, you open up a short position. You should sell it. by borrowing the stock from a broker and then later buying it back and returning it back. So you're trading at 60 bucks, and say you buying and picking it lower here at $40, then your profit is going to be 33% actually, because you made $20, but your initial investment was about 60 bucks. So you made a profit of 33%. Obviously, it can go the other way around, where you lose 20% in both cases or lose 33% in both cases, but that's a general overview of longs and shorts for those people who don't know much about it, right? So it's a great time to start talking about the training internship, right? That will take place at Brooklyn Risk Advisors. Let me briefly tell you who I am. Let me briefly tell you what we do, and tell you what people are we looking for, and how we can help you guys, help yourselves and help us. Because at Brooklyn Risk Advisors, we do have a policy of only working with people to whom we can actually help. Develop their skills and passions and interests. And we are expecting the same thing back from those applicants to whom we are, given a chance um, to improve themselves as a person, to get a new skill. And the skills that we're looking for are always practical. They're not going to be any coffee, getting coffees for the team. Because first off, it's a remote internship, and even if it was not a remote internship, for coffee, I could hire somebody for a cheaper price, right? See, really quickly who I am. So my name is Peter Borovic. I'm a senior partner in Brooklyn Risk Advisors. I graduated from NYU Stern with finance and statistics double majors and mathematics minor. My first job right out of college was Citigroup, where I doubled the returns for a $3 billion portfolio on the equity swaps desk. And then after which, I left to Brooklyn Risk Advisors, where here we are working on alternative models for predicting prices for alternative assets. Right? We mostly use mathematical and statistical models to help hedge alternative assets such as steel scrap, aluminum, glass, plastic, all that fun stuff. We do have certain presence in that market. However, recently we've been looking to something more liquid, because the steel prices are just being shattered, because the supply from China is decreasing, is diminishing, and we are trying to enter into new markets where we can make a difference right away. I also spent some time with my friends at 3Red, which is a trading firm, trading prop shop in Chicago, where I assisted in creating equity options desk for. So I worked there briefly, just for anywhere from 5 to 6 months. Then I got back to Brooklyn Risk. After that, it was a great experience, and I learned a lot from Red. I definitely enriched my experience, and after that experience, we started thinking from a completely different perspective when it comes down to to assets at Brooklyn Risk Advisors. The author of the book, the S&P 500 Playbook, you can check it out on Amazon. It includes 34 backtested strategies, which are super easy to follow, and do produce annualized returns of 200 plus returns, 200 plus percent. Of course, when it comes down to the stock market, you have to realize that um, the majority of players will tell you that you can only make 30% a year, and that's what I was thinking too. But Chicago experience at 3Red totally changed my mind, because when you are dealing with strategies that have a Sharpe ratio of 3.0 plus, 4.0 plus, 5.0 plus, there's no real limit to how much money you can make. And yes, when it comes down to investment banks, they'll be telling you that 35% is what Warren Buffett can make. But don't forget that Warren Buffett is managing billions of dollars, and he cannot look into strategies that present much higher profits, because otherwise he'll just move the market, because the opportunities like that are um, do not cannot exist when you're trading lots of big shares of capital. The reason why I can is because you can move the market and your arbitrage opportunity just disappears. So, and at Chicago, I learned that you can really make a lot more than 30% a year. You can make 100% a year. You can make 200% a year. You can make 300% a year, especially if you have capital under nil, which is super easy. And now you can try to number. Try to compute how much money you can make if you have $1 million of investments, right? And you have a good strategy that generates anywhere from 1 to 2% every day on average, including your stops, including your losses, right? So after I'm also the author of the Be the Market Crash Course and Trading Ninja Bootcamp, as I'm one of the co-founders of the Stack Investments. I'm also a contributor at Stock Tweets, which is a Twitter for stocks that has anywhere from 500 to 600,000 users. I've been contacted by the CEO directly, but I was going for yet another venture, so unfortunately we could not meet. But he was really interested in my idea, which is called Trading Horoscope, that in 2015 produced 20% higher return than S&P 500. S&P 500 was flat, and the Trading Horoscope on average gave me about 19.7% a year. So those signals are based on quantitative models. Again, it's all purely algorithmic. There's no no fundamental analysis. Those trades are up to 10 trading days and not more than that. I also just got back from the program called MBAs Without Borders as part of USAID, which is the United States Agency for International Development. And I was there on behalf of Pixar Global, which is a firm not-for-profit in DC, where I went to a developing country, Belarus, which is located closely to between Russia, Ukraine, Poland, Lithuania, and I was serving as a volunteer for 6 months as part of the, again, Pixar Global and IPM Business School. I just got back about 2 months ago, and over there we've been helping local entrepreneurs develop new business models that could work. All right, so that's my overview. If you guys have any questions, please use the question mark. I hope that this webinar is actually being recorded. Hello, I'm Ryan. So let's do a couple of questions. Hello, I'm Ryan. Currently, I'm associate in applied economics from the University of Michigan. I'm very interested in quantitative econometrics and trading. My questions are: how is trading in recent years? What is the main trend and direction of trading development? Thank you very much. So many people, especially my friends from Wall Street, they keep they keep pondering me on my head, saying that, oh, it's all AI, international intelligence, artificial intelligence, and it's all quantitative trading, which is mostly done through high frequency trading, and there's no chance for anybody to make money unless you do the same thing. But when I went to Chicago, and that was basically the biggest part, they asked me, my buddies, my friends asked me to help them develop the options desks for equity specifically. There have been two traders from Susquehanna in the past, SIG, and they've been trading now at 3Red. One person was responsible for fixed income on options. The other one was responsible for commodities on options as well. And they needed somebody who has experience in stocks and equity swaps, and equity derivatives. That's what I had. So they've been teaching me about options. I've been teaching them about stocks, and it was a very, very beneficial, synergistic experience that we've had. And over there, the founder of that prop shop of 3Red. His net worth, I cannot necessarily vocalize it, and I don't even know it, but it was a lot. And the guy was only 35 years old. And thinking how can a person with 30% a year, generate so much money without using high frequency and AI was very, 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 very interesting to me personally, and it changed completely my mindset about how much money you can make a year. Sure, if your strategy is pretty passive, you can make 30%, 40% a year on a good year. But if you are using new variables, if you are using new approaches, then it's not that the sky's the limit. You're probably not going to be able to make 1,000%, but you can really make 100, 200, 300% on a yearly basis, on a good year, of course, if you do everything right. And the most important thing was the founder did not trade using algorithms or high frequency, right? So he was just trading himself, and nobody knew how he was doing that, but he was really good, doing a good job. Nobody really understood because the guy is extremely smart. So the new trends seem to be AI and seem to be high frequency. However, there's so many different high frequency trading desks out there, and they all do the same thing. Master students and PhDs get out, and for the most part, they are liking that metaphysical, that philosophical understanding of the stock market. They just go for the same, moving averages, gaps, mathematical models, and do the same exact thing. And now their strategy is very similar to what the competition is doing. And if your strategy is the same, there's no way for you to make alpha for your investors, right? And one more question. I looked through BRA's website and was attracted by BRA. May I ask you about the strength of BRA and details in the trading industry, which changes so fast? So we've been our main focus is obviously alternative assets. Thank you very much for the question, Ryan. Our main interest is in alternative assets. So again, steel scrap, steel, aluminum scrap, aluminum, glass, plastic, all that fun stuff that does not have the primary markets where we can, help using our latest techniques in math and stats can help hedge the exposure of companies for these alternative assets. But recently, we've been looking into trading specifically stocks and commodities, and I wouldn't say that we are one of the major players right now, as we are just entering that market. But we would like to start growing that presence surely but slowly, and obviously that's going to be done through with our help, with our expertise in the industry, and also with the expertise in the industry of whoever joins us and helps us. This internship, though, therefore, though, it's not going to be necessarily helping expand the desk. It would be more of an educational background, and whoever shows the best results will be invited for an actual trading position in case we think that there's bread and butter that can be made from his or her trading abilities, right? Now, one more question. I didn't get the difference between mutual funds and hedge funds because mutual funds. Wow, that's a lot of questions. Question from Shishu. Didn't get the difference between mutual funds and hedge funds because mutual can do more trading than hedge. Yes, mutual funds do usually contain a lot more assets under management. The AUMs of mutual funds are just through the roof. However, mutual funds are somewhat limited. They can only do longs and selling out of their long positions. They cannot do any short positions. That's in the perspectives of the majority of mutual funds. And what happens is that because of that activity, there is usually a very high correlation between S&P 500 and the mutual funds. And investors who are looking for diversification of their funds are usually not investing in mutual funds. Well, they do invest in mutual funds, of course, but in order to get that alpha, in order to get that no correlation of the other buckets in their industry, they are looking for hedge funds and other alternative investment vehicles. Ryan, again, Ms. Peter, man, thank you very much for your wonderful answers. I appreciate it. I'm very interested. Very. Can I ask about the interview issues? Thank you very much. Yes, interview, we'll cover that. Taiho Lee, thank you for the presentation. My name is Taiho Lee, a senior of the University of Pennsylvania, studying math and engineering. You briefly talked about the hedge funds having lower returns than indices. No, they have higher returns than indices, but because of the irrational behavior of investors, investors do turn out to make lower returns, although they could make higher returns. Do you think the reason is purely behavioral? Yes, the reason is purely behavioral has been proved by I forgot the name of the Nobel Prize laureate. Um, Robert Schiller, right? So he mentioned that as well. That for the most part, it's purely behavioral. If you invest in a hedge fund, just forget about it. You actually get to make a lot of returns. And when you say people get out too early because they get scared and people get in too late when the funds are doing well, are you referring to the managers of the funds or the investors? I'm referring to both managers of the funds and the investors. The reason why is when you're on Wall Street and you make a contrarian move, and we're going to talk about it later a little bit in this presentation as well. When you make a contrarian move, in case you lose, you will be fired, and it's sometimes it's a conflict of interest when it comes down to investors. But most hedge funds and most mutual funds just do the same thing that everybody else does on the street in order to save their personal career. And even if everybody's wrong, you as an investor, you as a hedge fund manager can always say, well, I've been doing the same thing that everybody else was doing. However, if as a contrarian think you actually make money, then yes, sure, you can make it big, like like Bridgewater with Ray Dalio, like SAC, SEC Capital, like like any other big guy, like so. It's very critical to have contrarian thinking, but at the same time, many people are scared for their spots for careers, and that's why they move not always make the right move when it comes down to investors. Hey Peter, from Kevin Leong, what do you think are the most important topics to study while in school in order to be successful in quantitative investing? We'll cover that as well, Kevin. But basically, I was told once before I joined Citigroup. I was networking, and I asked the person, Greg Connor, that was his name. I still remember him because he turned out to be magically my interviewer. So I asked him, Greg, at one of the networking events at Stern, I asked him, Greg, what would you suggest? Do I take more economics or finance classes or math and physics? He said, math and physics, maybe statistics. So take as many quantitative subjects as possible and also try to improvise. Actually try to trade, actually try to borrow money like I did while from your friends, like I did while in college, and actually trade it because if you have positive track record, whether it's virtual or real money, you will have a lot higher chance to actually get a job. First off, secondly, you have a lot higher chance of understanding if you like to do trading or not in life, because trading is a very stressful career, and unless you have passion, you are not going to succeed. Ryan, what is the best way to reach out to you? I'm actually in New York City now. I want to go to your office for a talk if it's possible. It's from Ryan. Ryan, we're going to be discussing this later in the presentation. Wow, that's a lot of questions. That's actually good. Usually I want to ask a question about the Brooklyn Supervisor. If you don't mind, I went to the website and said that there is a highly specialized team of independent financial and economic analysts pioneering innovative solutions for underutilized markets. So what kind of underutilized markets? Again, underutilized markets, in our definition, are the markets that have no primary markets, such as steel scrap, aluminum scrap, um, anything that does not have a primary market, everything that does not have an exchange. Fernando Gallen was asking the question, what type of projects are assigned to interns? So we will talk about this. Okay, so now let's actually move to the presentation. Thank you so much for all your questions. That's amazing. So now we actually move into the trading internship part. And let's talk about the job description. I'm pretty sure all of you read it. Well, maybe not, because I mean, I've been at your spots too, and sometimes you don't read the actual description. You just apply as much as you can, which is fair. You sometimes you don't include the cover letter or make mistakes in cover letter because you use the same cover letter for all the other positions. So because of the highly competitive job market, that's unfortunately what we have to do. What you guys have to do as students. But responsibilities, right? So first off, responsibilities for the interns will include day trading on the virtual stock exchange daily. So we are trying to see uh, if any of you can come up with trading strategies for day trading in particular. We are going to be using the platform of Market Watch, which served as one of the best platforms. It's not perfect, but it serves one of the best platforms for this kind of trading, for day trading, despite the fact that many financial magazines and many investors say that day trading is negative in nature. Yes, it is, because investors do try to actually trade, and they do lose money. Traders do lose money on commission. However, you still if you have a great idea when it comes down to trading, you can still make anywhere from 1 to 2% on a daily basis. That's our goal, and we would like to invite people, specifically here, you interns from attending American colleges, to figure out the best algorithms or create a new best algorithms that could generate that kind of income. And in terms of successful implementation, those people will be hired, and they will be given some capital to trade. We are holding a similar event for students, college students from a developing country, Belarus, where I was personally going. When I was living for 6 months as part of the volunteering process. So it's going to be very easy and very interesting to see the difference between U.S. College students and Belarus college students. In fact, we're probably going to be you guys are probably going to be competing against them, whoever qualifies for the next round. So the second part of responsibility is developing and backtesting and live testing training ideas with a specific set of risk-reward metrics. Obviously, we're talking about Sharpe ratio. Obviously, we're talking about creative ideas. We're not talking about RSI, MACD. We're talking about, well, which you can also test the Bollinger Bands. We're talking about some really cool mechanisms and instruments that you could try to look at and notice while day trading, right? So for the day trading part, each qualified intern will have to put in anywhere from full plus full plus trades every single day, because that will allow you guys to see what patterns are out there and how you can exploit those patterns, and that it can only be seen if if you're on the market every single day. And last responsibility, well, there are many more, but basically, if you sum it up, assessing the appropriateness of quantitative models and the limitations for valuation risk management. You obviously have to include the stop losses. You absolutely have to include exits and outs. You will be working on backtesting the strategies on a daily basis using daily prices that you can access from free platforms such as Yahoo.com Finance or MSN.com Finance or Google.com Finance. You will only be open to daily prices, inter-day prices, and based on the prices and the volumes, you will have to create certain strategies to express your view for the entire day. So those are responsibilities. Now, qualifications. You are a student at a leading U.S. U.S. university, working towards a degree in finance, mathematics, statistics, physical engineering. You have a strong knowledge of or and hands-on experience with Excel, passionate about trading and markets. You have strong knowledge of technical analysis, and if you have it, that's a strong plus. And you have good intuition and understanding of statistical, financial, and econometric models, as well as estimations and calibration techniques, and experience with handling large-scale data sets. And that is also a huge plus. So if you major statistics or engineering or data management, then you are for some really fun ride, because you'll be able to implement all that knowledge in practical career. So you also have to have strong problem formulation and problem solving skills, with particular emphasis on ill-conditioned and loosely defined problems. As you'll see while trading, there will be so many things that usually do not happen and don't go as planned. So you have to somehow be able to look into that from the trading perspective, from the testing perspective, and include all these ill-conditioned and loosely defined problems. And strong communication skills and ability to work in a multi-team environment. The reason why is because you probably, whoever's qualified, will probably be split into teams in order to create the most innovative, strategies, trading strategies that, if work out successfully, will receive certain capital for trading. So, and the cool thing about this is, of course, the fact that you will have the first-hand experience on what is really going on. It's not going to be some economic theory that cannot be applied anymore in life or cannot be applied on a daily basis. Here you have the first-hand experience of actually developing your own strategies, and we will be looking through those strategies, and we will be correcting them. We will be helping you do a better job on these strategies. And in case you have a good track record, after this internship, you can either again get a position with us if you think that you're qualified, or have an easier time getting a similar position at one of the leading prop shops or investment banks. So who's our perfect candidate? Our perfect candidate is somebody who is willing to trade that's a mistake here, 2 hours per day at least. So the session is from 9:30 a.m. EST to 4 p.m. EST Eastern Time. We want somebody to trade at least for 2 hours every day. No holidays and no weekends, of course. Capacity to learn and learn fast, because you'll be given a lot of information to think about. You will have to constantly change your models, as you will see from from trading. Creativity for new strategies, right? So we don't want you guys to create the same strategy that they teach in school or they teach in books. We want you to actually use your creativity and use your understanding of the markets to get a better, more creative ideas that nobody else is trading. And by doing so, you will actually ensure that you are on the right path. And basic knowledge of coding is a plus. Coding or Excel at least, because every single trading will have to be backed up by a trading strategy. And if you guys don't have a trading strategy, your results will not count and you will not proceed, right? Because we want somebody with trading strategies. It's not going to be discretionary. It is going to be discretionary trading, meaning that trading, using the funds. However, we are looking for more systematic trading. So the next steps, and some people are asking, what are the next steps? So the next steps, in case you're interested in this idea, will be to apply for training internship with BRA. We are going to send you the link. We are going to send everybody the link, whoever participates in this webinar, and you have to fill out that form, so we know for sure that you are interested. We will also have to go through your profile once again, because our seats are limited to 20 seats only. And after that registration, whoever is qualified will be given a 2-week trial to trade through on the virtual exchange first. And by in the first 2 weeks, we'll see who has something to show or who has nothing to show. And based on those 2-week trial, maybe we might extend this to 1 month trial. We'll see whoever gets that internship. Again, the seats are limited to 20. Any questions about this? Because I would like to share, I would like to wrap it up, but before wrapping it up, I would like to give you guys some philosophy about what we think about trading. So let's see. Are there any questions? Oh, that's a lot of questions. Anurag Jain, what platform you will refer for developing strategies? Is it okay to build mean reverting strategies in R? Mean reverting strategies in R are probably one of the most undervalued strategies. In my opinion, mean reversion is one of the best trends, and it is backed up by philosophical and metaphysical understanding of what life is. It's backed up by behavioral economics. It's backed up by the actual research on historical prices. So mean reversion is something that, in my opinion, many investors don't look much into, and they should. And our MATLAB C++, whatever you guys want to do. We'll be more than welcome, right, to show the strategies. Now, Berg Torn is asking, how do the roles of training quant research interns differ? Quant research intern, these guys are doing the actual quantitative research. So you guys here are the ones who apply for the training internship. We're not hiring anybody for quant research interns. Quantitative research intern is people who actually come in and help us work on our mathematical models. Training interns are the ones who actually just trade on the virtual stock exchange. Now, Anurag Jain, do we require Series 7 certificate? You are only required Series 7 certificate if you are trading somebody's money, somebody's capital. You will notice that prop shops, if you work at an investment bank, you have to obtain your Series 7. However, if you're working at a prop shop or just trading on the virtual stock exchange, no Series 7 or other certificates will be required. Counter breaks. Mr. Borvik, thanks so much for this presentation. My question is, when the qualification says we are live testing models and new trading strategies, does this mean we are testing current widely popularized models, new strategies that we developed by those at BRA, or are we researching untested ideas we train ourselves? Connor, thank you very much. It's a great question. Yes, you will be given certain strategies to test. However, we don't care necessarily for our strategies to be tested because, as you can see, we are pretty qualified to test our strategies ourselves. The idea for training interns will be to create their own creative ideas. The idea, right? That's a tautology here. Will be to create your own creative ideas, creative trading ideas that you observe from day trading, and testing and putting that to the test, and then sharing that with everybody on your team and just with everybody amongst the trading interns, so that we could come up with some really cool trading ideas that, in case if they work, again, we'll be given the opportunity to be traded by. Okay, more questions. Sihan Ding, good afternoon. My name is Sihan, third-year finance student from University of Virginia. My questions are: what websites do you recommend to use for stock research? For example, Seeking Alpha, Financial Times. Think about news. You'll see and you will notice that, unfortunately, the news from trading for a long time, you'll see that news are not necessarily future-looking. By looking at the chart and by looking at the analysis done quantitatively, you will be able to figure out that the piece of news has to actually come out for that to happen. And I do not like to trade the news at all because, in my opinion, that's totally misleading. That's one, and secondly, it is already priced in. What amount of money we should invest as a start point? There's no money to invest. You'll just be trading virtually on the virtual account, so there's no commitment or anything. You just trade virtually. And in case your strategies work out, then we will be, raising capital in order to, or just using our capital to trade your ideas, and you'll be getting commission, something like that, or you'll be trading your ideas yourself. You mentioned it's better to take more math classes. What kind of math classes would be helpful to build quantitative models and understand the stock metrics? The best answer is this: you go to your syllabus, you go to your core, and you look at stuff that you are super excited about. If you're not excited, you go and ask me questions, right? People who are excited, they know exactly what they want to study, they know exactly what they want to do. So that just shows the passion or no passion for the stock market. If you ask me this question, chance that you didn't research yourself, so just please do. What coding language do you recommend to know? I can only know Java, Ruby, Rails, and VBA. For trading, you can do, if you know Java, if you know any language, you're okay. Because it's easy for you to convert to Python or MATLAB. The most popular language is Python on Wall Street, and MATLAB, and R. Tahoe Lee, I recently read the book for Randomness, where the author claimed the market participants constantly change, so historical data is meaningless. What you take in a time series analysis of the market? I do tend to agree that markets are, in fact, random, and there's random, Brown in motion, random walk theory, which indicates that the stocks are going up and down just randomly, and much of it is not being utilized. However, I also know that Bridgewater is always making money. I also know that Warren Buffett is always making money. I also know that SEC Capital is making money. So, in my opinion, although it's very hard to understand and to learn the stock market, because no matter how much knowledge you put into the stock market, you can always mess you up because it's random. Well, it's more random than not. There are still many financial organizations that somehow crack that code. So I'm a strong believer that it's possible to crack the code. High priority machine learning knowledge of the models. Thanks. If you do those models, great. If you don't, That's also great. It's up to you. Just use your creativity. I'm here from University of Wisconsin, John Zhang, medicine, major in finance and computer science. My question is that we're supposed to provide justification for the trading strategy first, or we can place the trade and justify after that? How are we handling the strategy? So about the handling the strategy, we are probably going to create some group, and believe it or not, while the majority of those big boys trying to look more official, we are probably going to create a group on Facebook where we will be talking, we will have having conversations, we'll be exchanging ideas, we'll be exchanging files, and the strategies will have to be held and documented over there through Facebook, and it's going to be a closed group only for those people, for those interns who qualify. So of course you have to qualify your idea before you enter into an idea. I mean, how else? Okay, well, that's a lot of questions. Diwang, my name is Diwang from UPenn. My question is, what are the language you're using for coding? What kind of stuff you need to code? You need to code your ideas if you want to be a trader. If you want to get, thing is this: we are looking for passionate people. We don't look for people who just want an internship. We are looking for people who will want to trade themselves, who are trading themselves right now. So again, if you're asking these questions, chances are maybe you don't have the passion for it yet. So it's very easily synced. Whoever has passion, not doesn't have passion. Here at Brooklyn Risk, we use MATLAB, we use Python, we use VBA. All right, so let me move on to and explain you guys a little bit about Fernand and Galen. I thank you for your presentation and answers so far. Drifting out of the industry details, I have a personal question for you. It's been quite an eventful start of the year. What has been the most surprising things for you in the financial markets? This year, personally, I just found out that mean reversion is a great instrument. Looking at the oil prices and looking at how news are being driven by the stock by the markets, not the other way around. It's not the news that drive the markets; it's the markets that drive the news. And that's been just the most surprising thing to me to see that that the confirmation in the markets. So we have just 11 more minutes, and thank you so much again, guys, for being in this webinar. So I'll use on trading just a little bit of what is our culture and how we think about trading. And it's not that you guys have to think in the same fashion, but we would definitely like your feedback. So first off, trend is your friend, right? So as many traders say that your ideal scenario is to figure out the trend and then utilize that trend. So if you're playing against the trend, you might get hurt. For example, here, right, if you look at the bullish market, if you enter right there as a short position because everybody's buying, right? Or like, for example, here in the middle, because the market's going up and you see that clearly that there's a trend of the bullish market and you take a contrarian view, then just like they say, sometimes you won't have some, you have to be solvent financially. So sometimes you won't be able to necessarily cash in because the bullish market is going for too long and there's a huge demand for that for the bullish market. So you are playing against the crowd, and sometimes you just need to be able to you just need to make sure that you are going to be solvent by the time that the the market goes your way, your direction. So because at the end of the day, it's great to be contrarian, but you make the most money following the crowd. And that's one thing that we have to understand is how to identify the trend. What are some instruments to do that? How to figure it out? How to forecast it, especially when it comes down to the intra-day trading. And this, on the other hand, just like I just mentioned, contrarian thinking is huge. If you're not contrarian, you will be just making the same money as the crowd, and the crowd is losing money. 80% of people actually lose money, and only 10% of fund managers outperform the S&P 500 based on the research. So if you look at this, right? So here you enter the stock, it's optimism and excitement. Stock goes your way, then you're thrilled. Then here you say, I'm a freaking genius, and you actually leave your job, and that's where the anxiety and the fear. That's where the anxiety and the fear come in as your stock is going down against you, but you're still up a little bit. But here you say to yourself, well, I already lost too much and I got back to my level, so how about I just keep holding it? So you're holding it a little bit more, and then you start panicking here, and here you think about capitulation, but you're not capitulated yet because you still believe that the stock market will go up. And here you'll say, you know what, market is a scam. I don't want to deal with that, blah, blah, blah. And then the stock. So you close down your position, the historical low, the market's low. And here you start thinking, you know what, maybe it's not a scam. And you enter at the same position as you entered before, relatively. So in this situation, this diagram, which is a psychological diagram of traders, whether it's professional traders or non-professional traders. It only shows that you do have to take contrarian views sometimes, but you have to take contrarian views at the right time. For example, Sir John Templeton said crisis is good, right? The time of maximum pessimism is the best time to buy, and the time of maximum optimism is the best time to sell. So he made all his money, all his fortune. He was called the market wizard of the 20th century in 1999 by one of the top financial magazines, and he used that same psychology of contrarian thinking, of mean reversion. But the main question is how to actually stay solvent while while doing it. Now you also have to understand that trading is not an art. It's an art, not science. You cannot just go get out of college and test like one of those you know uh, machine learning systems that constitutes itself based on historical data, based on the new data, and blah blah blah. It might work, but you have to understand that James Simons already made his billions of dollars by doing the same thing back in 1980s. All right, so you guys, by doing high frequency, you're not going to create anything new because it's been done 30 years ago. And that trend for doing high frequency trading, in my personal opinion, is just it's just like a bubble for Silicon Valley. Yes, it's great. Yes, it might work. Yes, it's hot. It's very hot to go to the investor and say, hey, my strategy is based on high frequency, but how much of it will actually be profitable? That's a question, right? And the other thing is Malcolm Gladwell. He wrote a book about the outliers, and he mentioned that 10,000 hours is the amount of hours that you become a pro at a certain topic if you keep doing the same thing for 10,000 hours. And he gave example of the Beatles, of like a bunch of different artists, of inventors and stuff like that. And the cool thing about this, and Elon Musk said it the best. He said it the best. He said, if you are working 80 hours a week, or Citigroup, or like any other investment bank, they ask you to work 60 to 80 hours a week. If you actually work 60 to 80 hours a week compared to somebody who only works 40 hours a week, you are twice as productive. And by the time, say you're 5 years old in Goldman Sachs, will equal to 10 years old in any other job. So same thing applies here to trading. That's why we want people who are passionate about it, because we want to see if you guys can actually put in the hours in order to develop certain skills. And it's not going to be, if you don't know anything about markets, it's not a problem. The problem is not learning fast about it. The problem is not being passionate about it. The problem is not following it, not putting the hours into it, because at the end of the day, it's all about the hours. It's all about how much effort you put in. We also noticed that introduction of new variables is something that drives the markets a lot, and something that, just like introducing new products, new variables is something that can drive the future of trading. So by looking at this chart, like whatever the chart is, I think it was just, I don't know what it was, it's some chart. You have the stock, you have the volume, right? And when you look at the stock price, you have time series of high, low, open, close adjusted, if anything, plus the volume. So you have 5, 6 series, time series, which you can analyze in order to come up with things like price, moving average, volatility, correlation. But the thing is this: when you're looking at these variables, you are limited to what you can do, right? Moving average, it's been there for 20,000 years. Volatility, same thing. Correlation, same thing, right? Mean reversion for the two stocks, same thing. So by only using the same variables, you will not necessarily go far, because you can't go far using the same thing everybody else is using. So you got to introduce new variables. And the best example for the introduction of new variables are, could be presented by these 3 examples. For example, single speed, right? Signal speed. So guys, high frequency guys, instead of creating another high frequency strategy, they just locate it closely to the stock exchange in Jersey, or like super close, like on Wall Street. And now their signals are faster. So they are, outplaying whoever puts the order, and they make cents of a cent. Like not cents of a cent, probably bips, right? Basis points of a cent from every single trade, but they make so many trades that is beneficial for them. And they did that not by analyzing pricing or volume. They did that by locating themselves closely to the market, right? Oh, date of earnings, which is probably, somebody asked me about the most surprising thing that happened this year. I'll tell you, the most surprising piece of research that I found last year was date of earnings. So there was a guy, I forgot, it was probably from MIT. He was, again, doctorate or master's thesis, I don't know. He was writing something, and he did the testing about when companies report. So for example, last year the company reported on February 4th, for example. Now this year, if it reports a little bit earlier, chances are, like February 2nd, chances are the reporting is great, earnings are great. But if you report a little bit later, chances are earnings are bad. Why? Metaphysically, check it out. You got an F, or got a C, got a D. and you go to your mom, to your parents, and you don't say that out loud. If you got an A, you say, "Oh, I got an A, mom." But if you got a D, you'll say, "Oh, like a week later, you'll say, I have a D." So we tend to be very fast at expressing our positive news and tend to be a little bit lower, a little bit slower when it comes down to negative news. And when there's something negative happens, we try not to, not to say that. Because it might change, right? Because we have some psychological, behavioral things inbuilt in us, because we all human beings. And he used that same metaphysical explanation to data earnings, and it was probably, in my opinion, that's one of the most creative, piece of analysis that has been done out there in the last since ATM. I could not find anything more interesting than this, because it's so simple yet it's so powerful and so true, and anybody can relate to it, and it worked out statistically as well. Or third, just alternative assets, right? Instead of introducing new variables, how about you introduce a new asset, right? Like we do here, like say steel scrap, like aluminum, like electronics, old electronics, used electronics, plastic, glass, stuff like that. So that's how we think about. That's how we would like to think about trading, and that's how we will be teaching you about trading. Again, this internship is purely remote, so you can trade from from wherever you live. We don't want to see physically, and well, said it. I should say we do not expect to see physically, because it's a purely remote internship, which is kind of in line with the latest startup moves, where the jobs are moving more towards working from home and stuff. So we try to be on this edge. We also going to be using some modern techniques like Facebook groups and Twitter, maybe LinkedIn, just to make sure that we're in the trend. So it's going to be more like a startup, more like a trendy prop firm opportunity, where you guys can really make a difference and create some strategies that can make you money at the end. If you guys have any questions, here's our email, careers@brooklynriskadvisors.com. I'm happy to take 3 questions, and then we're gonna wrap it up. It's already 5. Again, thank you so much for attending. Anurag Jain, what is your opinion on correlation between oil and equity? Anurag, yeah, lately you'll see that too. Whenever there's panic, whenever there's a bubble, specifically panic, mostly based on fear, not greed, you will see that many assets become cross-correlated. So oil market and the S&P 500, the stock market, will be very, very correlated. And so we've been seeing for the first couple of weeks of this year, when oil prices started recovering. And that's the same thing you'll be able to see every time. And that's the biggest obstacle for diversification, because when everything is in panic, all assets tend to move in the same, at the same rate, which might kill your portfolio. Shiva Chandra, great talk. Wanted to know if you involve transaction cost analysis in your models. Thanks. Transaction cost analysis in your trades. Sure, you can think about that too. However, chances are we're not going to be looking for people who can do high frequency or artificial intelligence. We want to see people who have strategies that are a little bit more long term, not every single second, maybe 5, 10, 15 minutes, half a minute, half an hour, but definitely not getting in and getting out right away. So the transaction cost analysis might not be necessarily relevant for us, but you guys will be trading 4 trades every day, at least through virtual accounts, and the virtual account meaning that it's not real money, and the commission over there is going to be about $80 per day. So $10 per buy and $10 per sell. Last question, if anybody can shoot it, and we'll wrap it up. Okay, I'm waiting for one more. Thank you so much for attending, for your attendance. I hope you liked it. I really hope you liked it. We've been preparing for this webinar. We even did a webinar, which is a pretty modern thing for any financial firm to do. Okay, so if there are no questions, again, I would like to wrap it up. Thank you so much for attendance. Whoever signed up for the webinar will receive an email link. Whoever did not participate in the webinar can still replay by Monday. Those people have to, everybody has to basically, I think the deadline is March 16th. I'm not sure. I need to consult with Ted Haywood, who's our HR specialist. So you guys need to respond by May 16th or May 17th with the answer whether you're interested in this or not, and then we'll go through your profile one more time to see whoever's qualified or not qualified. Then after this, again, you'll have a 2-week trial for trading. Based on this 2-week trial for trading, we'll decide who will obtain that internship, who's not. Thank you so much for your attention. It was great questions. I appreciate that. Have a good day. Bye bye.